Hey guys and girls, welcome aboard to another Tuesday night live. Just getting a computer set up and tune in. So as always, thanks a lot for entrusting me with your Tuesday night entertainment. As always, none of this is financial advice. I'm not your financial advisor. But you know, if you go to one, they're most likely going to be like your doctor and like everyone else from the system. So it's they're only able to prescribe a certain medicine for a certain product. So on that note, gave you my little disclaimer here. Got lots and lots of cool things to talk about. Lots of paper here, lots of throwing around of things, lots of cool information out there. Lots of funny things to talk about in this weird and wacky world that we live in 2022. So I can see a lot of you guys are hopping online now. If you're liking the video and you can hear everything, smash up the likes. Make sure you share it with your friends, your family, your colleagues, anyone that needs to be alerted of what's happening out there in the world. I think there's about 15 different articles and different things that I've got here today. And I'm going to do a few things a little bit different moving forward. Every week, what I'm going to do is I'm going to bring to you articles based on what companies are going bankrupt. We're going to walk through the recession, the recession we had to have together, and we're going to look at all the doom and gloom, pull it all apart, and see what really is happening out there. The first article that I want to get onto tonight, I've got lots of messages coming through here as well. I've got a few little notes here. Just following up from last week's, obviously, changes with the RBA deciding to put up the interest rates. So a lot of people I see out there are very freaking out, they're panicking and all this sort of stuff. I just want to go through a few comments that have come from the media. These aren't my words. These are words from the RBA. These are the words from the media. These are the words from the government and your politicians. So let's just go through them, and you tell me if this is true or false, or if there's a lie here. This is what the RBA said. The rates will not rise until 2024. Did they or did they not say the rates would not rise until 2024? In my view, that's a lie, because we're in 2022 and they've pulled the rug already, right? And it's funny because they have no control over the economy. That's why. But anyway, so first one that the RBA said has been a big fat lie. Rates will move up. They said the next movement, this was in February 2019, Philip Lowe said the next interest rate move will be up. That was in February 2019. In June 2019, what happened? It was only 4 months later, interest rates came down for the first time. So their feedback then was a lie. Inflation will stop by 2023. Well, we're not there yet, but it's pretty fucking obvious that it's a lie, right? I remember about 3 months, 6 months, 12 months ago, when inflation started coming out, they said inflation was transitory. The word transitory. Don't worry about the inflation. It's just a little bit transitory, meaning it's only going to be here for a little while. Nothing to see, nothing to worry about. Well, is it really transitory, right? What has gone up this year? I think I've got some charts about what's gone up, but I've got lots of different things, lots of things to look at today. A few things that I want to really clarify is that in the US, they started raising their rates a little bit prior to us, probably 3 months, 6 months ago. They have been in a recession last quarter, and on the 15th of July, they will release their data about this quarter that's just been. And the question that I would be having is, would we be positive with the growth that they would have had in the US in the last quarter, or would it be in decline? If it's positive, well, then it's a lie, right? If it's negative, that would mean the US is in a recession. A recession is 2 negative months of GDP. So if we are in a recession in the US come next month, what would that mean that they would do? most likely they would change the course of monetary policy, and they would go from quantitative tightening, which is what they're doing at the moment, and they'll take it quantitative easing, meaning that they'll print out more cheaper money. So just keep an eye out on or around the 15th of July. So it's only a month to wait. I guess the reason why interest rates are up is because how would I explain this one? This one's a bit of a difficult one to explain. But interest rates go up because everything else appears to be not a safe harbour, right? So if all the money is going to bonds and whatnot, it's a liquidity pool, right? I'll get back to that in a little bit further. The other thing I wanted to talk about this week was, I don't know if we've got an article here, do we? Oh no, we've got that. We'll get to that in a moment. One thing I've been doing over the course of the last week, apart from being sick, apologies guys, I do have the flu. I'll be here. I think I've got the flu. I don't know. One thing I've been doing over the last week is talking to all different people about their business, right? So, talk to a hairdresser, right? Obviously not my hairdresser, because, got to go for one. Been talking to a hairdresser. The hairdresser said people are literally pulling out from doing their haircuts and whatnot, just due to the fact that, they can't afford it. Second thing is a plumber, hard to get business. Talked to my renderer that's rendering the motel up in the Blue Mountains, said that 4 builders that he's doing rendering for have failed to pay their payments. What that would indicate is that there's an issue with payment out there from builders and lack of liquidity in that system. Spoke to my chiro the other day, and I asked him, do people pull out because they can't afford it and whatnot? And he said, look, there has been, a little bit of weakness there in our bookings. Interesting. The most interesting one that surprised me was I went to get a juice from a local cafe the other day, and the juices are like $10, right? $10 for a little juice. And they said, we're not doing juices at the moment. I was like, why aren't you doing juices? And the lady was like, the problem is that the cost of the materials to put into the juice is too expensive, and people don't want to pay more than that, so we're not doing juices at the moment. I was like, fuck, you can't even get a juice, right? So if we think about it, going back for the last 24 months, we've been talking about getting access to cash flow, getting access to assets, getting access to power that's off the grid, which we're going to talk a lot about today. Talked about getting access to water and food. So, and having a community of people that that you can count on should your currency fail, which is what is happening at the moment, is your currency is failing. That is exactly what is happening here. As I said, I'm going to be covering off on a lot of businesses tonight that I've got articles for in the news, and if you guys have any other ones that you are seeing that have blown up recently, throw them in the comment section. I'll get to them a little bit later. But going back 2 years ago, I talked of a thing called a zombie company. This is why I have no money in paper assets, and fortunately enough, I actually got rid of a lot of my crypto just previous to all this crash. And I was upset because I'd pushed myself so hard. I'd bought all these motels and different sorts of properties, and I need to offload some of it. And here we are. So in hindsight, it's been all right that I sold some. But looking specifically, not at crypto, but just at the zombie companies out there. So many businesses would have blown up 2 years ago if they weren't getting stimulus checks, if there wasn't cheap credit, if there wasn't a big Ponzi scheme that kept growing. So what we're seeing now is the removal of stimulus packages, the removal of cheap credit, available credit. We haven't even seen a recession yet, and all these companies are starting to blow up. A lot of people are fearful of what would happen if interest rates go up to 20% or whatever. Where should interest rates be at? Interest rates should technically be at double digits, but if you had double digit interest rates, you would never have seen any of your properties go up or anything change in the world. And volatility in markets is where the opportunities lay. But yeah, interest rates should be much higher. Will they go up? No, right? It's very obvious to see. But I did some quick calculations here, and I made a little note of my phone. Let's say if interest rates were to go back to where they were in the 1990s, right? Let's go and play a little game. Go and ask if you're maybe 40 or 50, you would remember 1990s. If you are older than that, you'd remember it. If you're younger than, say, I don't know, 40, you wouldn't remember the 1990s. So go and ask your friends, your parents, your uncle, your auntie, whoever, a couple of questions, right? How much at 20% interest rate was their house worth? And then look at what it's worth now. I'll just use some quick examples here. Let's assume that we go back to 1992 when interest rates were 20%. Interest rate of 20%, the price would have been about 150K. So 20% of 150K would be $30,000 per year in interest. And that was a lot of money, 30 grand a year. If we go and look at someone's interest rate now, and they've got a $1.5 million mortgage, or a $1 million, let's say $1 million mortgage at 3%, and that's 30 grand a year. If we go and look at the interest rate and put it up to 6%, that'd be 60 grand a year. If we go and put the interest rate up to, and the price up to 1.5, and the interest rate up to 6% of 1.5, we're looking at 90 grand per annum. So as you start overlaying, right, data, you will start to see, like, putting things in perspective. Back in the 1990s, an average wage would have been like 40 grand, and you'd only need a one person working in the household to keep the household operational. Now, most households would have an income of around 150 a year, and you'd have the husband and the wife enslaved to having to work. You might have different mixtures of different genders, if people like that, but you would have had two people enslaved now to pay the mortgage, but back in the 1990s, you would have had one person enslaved to pay the mortgage. So they've literally enslaved our quality of life to force your spouse to go and work. So looking at the numbers, if interest rates went from 3% of where they are now up to 5% or 6%, we would be in a situation probably double as bad or worse in adjusted dollars today than what we would have been in 1990. So thinking of 20% in 1990, 6% is really 20% of 1990 of where we're at. And we haven't factored in your afterpay, your credit cards, your personal loans, the loan for your furniture, the loan for your car, the loan for your dinner, the loan for your clothes, or any other sort of loans that you've taken debt on, or the fact that everyone else is covered in debt today. So just, that's one of my little notes. And the final one is that people are scared of rates crashing a market. The reality of it is that interest rates have the ability to go up because inflation is so great, so you've had a good market, right? So just remembering there's part and parcel of the cycle of the money. But we're at a point now where they have no strings to move, and that's why I'm laughing, and I think that what we've got in front of us today is very transitory, right? The only thing transitory here is the fact that that these interest rates, as far as they'll go up, my belief system is that it's mathematically impossible, unless we're going to have the biggest depression the world has ever seen, that they'll have to start unwinding this policy. Now, getting onto my copious amounts of data here, and I'm going to go through the respectable information that we are faced with here in the media. So this one here is an article that I just got texted to me from one of my investors. It's an AFR article listed today. So this is really funny. It's like all the media outlets watch my data and my information, and they put out their news, right, a month after it happens, right, or 2 months after it happens, or 6 months after it happens. So if you guys can't get access to the AFR because you don't want to spend money on it, there's this website called 12ft.io. So 12foot.io. So 12ft.io. It's a little website link. You go to it, pop your link in, and it removes the paywall. That's how you get stuff. So if you get articles that you don't have to pay money for, go to that 12ft.io and drop your link in there, and you get the paywall removed, so you don't need to subscribe to everything. If you like that, smash up the likes. This one here is the funniest. So this is why I'm going to start today off with this one. The interest rate jump adds to government debt cost. The federal debt bill is poised to jump by more than $20 billion after the government borrowing rate shot above 4% on bets of aggressive interest rate rises by the US Federal Reserve. The Morrison government's March 29 budget and Treasury's pre-election economic and fiscal outlook assumed the government's bond yield would average relatively low 2.3% through until 2025. But that forecast now looks increasingly misplaced as central banks respond aggressively to rising inflation and bond investors demand higher interest rates. In the short term, the higher interest rates would be more than offset by the high commodity prices and low unemployment, delivering higher nominal revenue to budget coffers. During the scandemic, the government's debt manager, the Australian Office of Financial Management, borrowed at cheaper rates at a weighted average term maturity of stock treasury bond of 7.2 years. But over the medium term, the government will be forced to refinance more than $1 trillion of debt at higher rates than previously assumed. Let's just get this right. The government will have to refinance $1 trillion of their fucking debt, which is what we've been talking about for the last 12 to 24 months. Right? I said this from day one. We are stuck with ZIRP, zero interest rate policy. It cannot go up. So anyway, the impact will build over time as rise in yields only affects new issuance, including as debt on issue matures and needs to be refinanced. So it's not necessarily the debt that's locked in today, it's however long that the government has taken out the debt for. It's when they have to refinance that interest rate will have to be matured at a higher rate that it gets refinanced at. If it doesn't, it defaults. So either the country goes bankrupt, or they have to pay a higher interest rate, or they have to drop the interest rate. Which one's it going to be? Every single country is in the debt. It's a big predicament, guys. It's a big predicament. It's very fun, right? Because it all leads to one thing, and that's the rates to come back down. Macroeconomics advisor and former Treasury economist Stephen Anthony said, history showed that over the last 50 years it was not necessarily true that nominal growth rates outstrip interest rates over time. Interest rates were higher than normal economic growth in the 1980s, 1990s and 2000s, according to his analysis. Mr. Anthony warned combined Commonwealth and state debt could almost double to 55% of GDP by the early 2040s. Let's just think about that. The state and Commonwealth debts could double to 55% of GDP. Right? This debt build-up leaves little scope for funding major structural spending fixes, nor does it provide any buffer against other national emergencies and global risks. Global stocks are falling. Let's read a little bit of this one. Stocks around the world have fallen heavily as borrowing costs have jumped in reaction to surging inflation. Goldman Sachs tipped the Fed to raise rates to 75 basis points this week and by another 75 basis points in July after the US inflation hit 8.6% last week. So let's just get this right. The US is seeing the interest rates go up by another 75 basis points and then by another 75 basis points. So it's going to go up by 1.5% in 2 more months. So interest rates could go up very high, is what they're saying. However, how high can it go, right? Because every one of these companies is going to implode. The bond market is pricing in a US recession after the yield curve inverted, which means the projected interest rate falls, not rises over time because its expectation the economy will shrink. Let's just reread that again. What I've been talking about, negative inverted yield curves. The bond market is pricing in a US recession after the yield curve inverted, which means the projected interest rate falls, not rises, over time because of expectations the economy will shrink. We've seen 2 petty, minuscule, micro, fucking nothing interest rate rises. Everyone's freaking out, but that's not what it is. Not just that, we've seen the whole system starting to implode, and we'll get on to those articles now. Yeah, lots of stuff there to read, but it's a fun article. Thanks a lot for sending that through. So So let's get into our bankruptcies of the week. We've got here an article here from news.com. Queensland-based construction contractor earth-moving contractors in strife. Another Queensland-based construction contractor has hit major wall this month, owing $7 million in following a contractual dispute. Another Queensland-based construction contractor has collapsed. Anyway, that's pretty much it, right? Let's not go too deep into it, right? Every week we've got building companies going bust. We've got shops going bust. We've got retailers going bust. Where's the other one? It's not here. It's not here. I'm going to read it out anyway because it's not here. Revlon, right? You know that mascara shit that chicks wear? Revlon, gone broke, right? It's minutes away. It's one of those zombie companies. So we've got here a construction company. We've got Revlon going broke. Go research it. Revlon's going bankrupt, right? Another one hits the dust. Interesting. What else have we got going broke here? Right, I'll go to the end of my notes, right? I'll go to the end of my notes. What do we got here? Not that. We're going to leave that aside. This is the fun one here, right? I literally had these chats with Ridwan many times about how this company would go bankrupt during the GFD. It's not that one. We'll leave that there. The entire buy now, pay later industry on the brink of collapse. The industry was once lauded as the genius invention, but now it's close to the breaking point, with millions of Aussies set to miss out. The buy now, pay later BNPL sector returned for the headlines for all the wrong reasons last week when the founder of a major BNPL service provider lost most of his $800 million fortune after his shares tanked. US founder of Cecil, Charlie Yoakim, was riding a high when Cecil shares were worth about $9.20, but several days ago they crashed by 96%, plunging to just 40 cents. Now, an expert has warned the entire industry is teetering near the edge of extinction as cost of living pressures drive Australians away from spontaneous purchases. Right? So we've got another construction company. There's multiple of them, right? I could read out all the construction companies every week. We've got Revlon going broke. We've got the buy now, pay later, afterpay style stuff tanking in the arse. What is it going to be next, right? What is it going to be next? That's the cool part about where we're at. I'm going to leave this one for a little bit. We'll put that to a little bit later because that's a fun one as a topic of discussion of manipulation again. But then I want to take you to this one here. Wait, where are we at? That's a really funny one. I'll get into the power shortly, right? The power outages, because that's the real fucking cake, eh? That's the real fucking cake here. Okay, let's go here. Let's go here. So, all ordinaries index plunged $116 billion as global stock markets are smashed. Wealthiest Australians lose billions. That's the headline. Can't make this stuff up, right? We've got a great economy. We've increased interest rates twice, off zero to not even 1%. We're not even at 1%, and the whole financial system is utterly fucked, right? There's no other way of saying it, so I just got to be clear with you. So this is before open today, right? ASX 200 minus 5.818%. I don't even know where it ended. They probably had the plunge protection team come in the afternoon and fix it all up. Where are we at? Let's go have a look at it. It's down 3.55. They left it pretty fucked, right? But then when you have a look at this, right, you've got the stock markets crashing. You've got the zombie companies blowing up, right? You then look at this side, and we're looking at treasury bills. What do you see here? Everything's in the green, right? What's happening is that funds are making sales from here into bonds, right? We've got the bond market going up. So yes, it is tipped to go up a bit higher. But let's go and read what we have to see here. Some of Australia's biggest richesters have lost 12 billion in a matter of hours amid today's stock market carnage. Australia's 4 rich people saw billions flash from their personal wealth. The local stock market nosedive in response to fears interest rate rises in the US could spark a whole worldwide recession. Mining magnate Gina Reinhardt, 30.34 billion. Yeah, I don't give a shit about these people, eh? Covers 116 billion wiped off the ASX, 200, sorry. Look, it's pretty straightforward, right? We've got the stock market crashing out there. We've got the crypto market. I haven't looked at Bitcoin recently. Bitcoin was down 17% when I looked like 3 hours ago. So looking at every market, right? Looking at every market, we've got crashes everywhere. There's nothing. What's going up apart from interest rates, bond yields, and bigger Ponzi schemes that they need to create? This is only the start of it, right? They've done 1 month, 2 months, right? 35 days apart. It's been about 42 days, 6 weeks since the first interest rate increase. Now we've had 2 interest rate increases. We've got share markets imploding. We've got crypto markets imploding. We've got businesses imploding. What's it going to be next, right? Is it going to affect the property market? How long are they going to leave it like this for? Where are we heading to? Now, when we go on talking about what's coming next, let's have a little bit of a sidetrack. This is a really bullshit article, right? Let's take the article for, let's not look at who published the article. Let's just look at some stats in it, right? This is from the Daily Mail. This one here says, huge tax reform could save you thousands when buying a house. Dominic Perrottot to finally axe stamp duty in the New South Wales budget. Oh, wow. Good work, Dom. Good work, mate. You're axing stamp duty. Let's go and look into a little bit further. Home buyers in New South Wales will no longer have to pay thousands of dollars in stamp duty under a plan to be unveiled in next week's state budget. Premier Dom will finally move to phase out the hated tax, which is paid to the state government by a buyer purchasing a home. Instead, the paying of the stamp duty fee up front, buyers could choose to pay an annual land tax to the State Department instead. Anyway, I don't need to read the rest of that because I think we get the drift of it, right? So they're replacing one tax, which is a one-off tax, right, to an annual tax, right? And it'll be more and more and more. So if the economy, if they scrap the stamp duty, right, there would be no revenue for the state. The state's revenue comes from stamp duty. So if we look at the next big hurrah that's going to happen, when they remove stamp duty, they allegedly remove stamp duty, that means that if you needed to save 100 grand to get into a property and then 50 grand in stamp duty, you would only have to save 100 grand. So it's only 50% cheaper to get into a property now, meaning that there's more upside there for the next boom to occur. But then when you take that backwards, it's going to have a water. When you take that back a step, imagine if the state wasn't getting their cash flow because there was no transactions, we had a property crash, whatever the case may be, that means that they wouldn't be getting their money. So they need to get more money to pay more of their debts, right? So the governments, the state, the federal, the local, all of them are getting themselves more and more enslaved to this banking system, right? And yeah, interesting times, right? Interesting times. If we see stamp duty disappear, that'll cause a new boom because people that couldn't buy property or were locked out for capital purchasing reasons would now be able to get into the market much, much easier. So, oh, this one is a classic, right? This one here is an article off Zero Hedge. Obama Treasury Secretary blames the insurrection, denies for inflation, warns the US is at risk of recession in the next year. So let's go back a step, right? I'm not a Donald Trump fan at all. So don't, think I am. But we've had blaming a Chinaman eating a bat, right? That caused a worldwide pandemic, which hadn't forced biometric identity, had to force vaccination, had to force multiple different things around the world, right? We've had a shortage of electronic car chips. We've had a war in Russia. We've had the drought, the floods, the fires, right? We've had countless amounts of boogeymen that are out there that are causing inflation to occur, right? We've never seen inflation being blamed because we've got a corrupt, really, really corrupt financial system. Never, right? But now we have a risk of recession and massive inflation because of Donald Trump, because people stormed the White House. Former Obama administration Treasury Secretary Larry Summers predicted the US would enter an economic recession and suggested the possibility of yet higher gas prices than the country is currently seeing. I think the optimists were wrong a year ago in saying that we have no inflation. I think they are wrong now. If anyone is highly confident that we're going to avoid a recession, he said on CNN's State of Union. Adding that the Treasury Secretary Janet Yellen, which is another criminal, wish she'd die, but anyway, and the Federal Reserve Chair Jerome Powell predictions too optimistic. I don't wish death upon people, but this lady is very, very evil, right? If you don't know who she is, go and research her. She was the chairman of the Federal Reserve, so she was the one at the control of the Federal Reserve, and she'd be the one that would be signing the signature on the back of those plastic and paper pieces of money that everyone trades and fights over and creates a war over. The combination of high inflation and low employment is always followed within 2 years by a recession. I think there is certainly a risk of recession next year, and I think that given where we've gotten to, it's more likely than what we'll see a recession next 2 years. Finally, Summers has found a new culprit behind America's inflation crisis. Republicans who downplay the severity of the 2021 January US Capitol riot. I think it's banana Republicans who was saying that what happened on January 6th was nothing or okay, undermining the basic credibility of our country's institutions. And in that, the turn feeds through to inflation, because you can trust the country's government, why shouldn't you trust its money? Let's just read that again. And turn it feeds through to it for inflation, because if you can't trust the country's government, why should you trust its money? In exchange for CNBC last week, Yellen said, I don't think we're going to have a recession. That's interesting that she said that. In a response to a question about stripper-turned-rapper Cardi B's recent Twitter post that asked when you all think there is going to announce that we're in a recession. Anyway, it goes on to say, the Biden administration and Democrats have struggled to deal with the price jump, blaming it on supply chain issues, Russia invasion of Ukraine, as Joe Biden recently signed a $40 billion deal in aid to Kiev. Biden and other Democrats have suggested Americans mitigate the cost of fuel purchasing electronic vehicles, which may be cost prohibitive or impractical for many. Right? Very, very funny. That's probably one of the funniest things I've seen on the internet. Inflation's here because of that. You're kidding me. Let's talk about a very, very important topic here. A lot of you may have been watching the news lately, and if you have, you'll probably see something along the lines of suburbs plunged into darkness as blackouts hit Sydney, with the entire east coast under threat of outages. Energy shortages. Lucky we talked about getting yourself solar, getting off the grid, getting your own food, getting your own energy, getting your own water. Very, very important. Why are we now seeing issues with energy? And it connects with everything, right? It might sound like, Nathan, talk about property, right? Talk about property. I will talk about some property later. I'll talk about some cool property deals that I've been working on, that I've been wrapping up for my clients in the last week. I've got some cool things to share on that. But this has everything to do with that, right? Because if you push the interest rates up, well, then what happens to the market? If you push interest rates down, what happens to the market? You push up rents. The tenants are so poor they can't afford you rent. Many different things occur. So, why are we having power outages? Is it because everybody is now connecting a heater in their house because it's so cold? Is it because everyone's got their aircon on 24 hours a day? Because of global warming? Because we've got a climate change catastrophe occurring, right? Or is it due to the fact that this chart here, does anyone know what this chart here is? I'm going to take comments, see if anyone can play a guess, right? What is this chart of here that I've got up on the screen? I'm going to go down. Anyone got it? Not commodity prices. Thanks, Clinton. Cash has be flowing from stocks to bonds and commodities. No. This chart here, it is a cool chart. This chart is coal. Coal. That there is the coal price. That is commodities. What does the power station need? What does the power station need to run? It needs coal. Without coal, you don't have a power station. You don't have a power station. So you need to take this one and put it in the power station, and then you got power. But if you don't have this one, in this one, then you're screwed. If this one's too expensive, then this one goes bankrupt. So I actually touched on this about 6 months ago when we started seeing blackouts and power outages all around the world, because every country was doing it. Now, the cost to the power station has gone up massively, right? Coal's not the only thing that it runs from, but let's assume that it's normally about $100, right? And now it's at $400, right? That's gone up 4 times. If the cost of your petrol went up from $100 to $400 in your car, it'd be sort of counterproductive having to go to work because it would cost you too much to get to work, right? So when the coal is too expensive to go into the power station, either the power station is going to go bankrupt for giving you the power too cheap and not passing on that cost, but the power station is putting up the cost by 100% next week or week after. In the start of July, power goes up 100%. So your power price is doubling. But that means that gets us to here. What about the cost above that, right? We've got a hyperinflation occurring in lots of different markets, right? We can make an off-balance sheet transaction occur and wipe out debt that's been created from cryptocurrencies or whatever the case may be. But when you look at commodities, you need this shit to fuel these things, right? Now let's assume that power goes up double. Let's assume it triples. Let's assume it quadruples. If it doesn't go up, the power plant goes bankrupt. If it does go up, what happens to our economy? What would happen to our economy? So let's assume that the power goes up at Woolworths, 100%. Well, how much would the power cost be for these companies? Well, it might be 30% of their expense bill. So that means that they will have to pass it on by giving you a 30% increase in your cost of goods, right? So as we're starting to see these levels of inflation, these are not, you can blame them on Donald Trump, you can blame them on a Chinese man eating a bat in the back of a wet market, you can blame it on the alleged sort of staff shortages because no one wants to go and get themselves the this sort of thing that occurs, right, in the arm, wherever it goes. I wouldn't even know. I think that's if I was doing ice. I think this is what I was doing if I was to get something else. But we can blame it on whatever, right? We've got a staff shortage out there. What about the staff, all the teachers, the doctors, the nurses, and that don't want to go and give away their bodies, right? That's a totally different story. We can blame all these things. The media is all about blaming things, right? This is undeniable, right? They can't afford to fill up. The cost has gone up 4 times to fill it up. The power plant can't run the power. Anyone that's using power now has to pass the costs on. That is what's going to cause our hyperinflation, right? We will not see these rates up for very long, guys. We will not see them up for very long. On that note, once again, I've got another chart. Yes, we know stock market shit itself. It'll probably shit itself some more. And I don't have any paper assets. So, that's my position right now. It's been that way for at least a decade. since the GFC. Here we go. Let's go and read a new article here. This is another one. I like news.com. They're friendly. They're fun, right? But anyway, what can you really trust in the media? Not going to go back. Experts' horror supply chain prediction revealed. The world's supply chain crisis isn't going anywhere in a hurry, with an industry insider making a grim prediction about what comes next. The supply chain nightmare that has been plaguing the planet for years is set to remain for the long term, according to industry insiders' grim prediction. The problem was caused by severe backlogs across major supply chain hubs as a result of the corona pandemic and later the invasion of Ukraine. Seriously, they blame on everything, right? Use it to your advantage. I blame everything on everything of these, right? It's fun. It's so great, right? So great. Whenever I can't or don't want to pay the government for any of the extortion fees, it's like, look, just because of the war in Ukraine, things have been really slow, and how about we pay it in 2 years' time and I can keep the money and buy better shit now, right? It's control of your capital, right? Anyway, while many expected the crisis to ease and now the world was transitioning to a corona normal, it seems it may not be the case. Speaking to Bloomberg, Tim Schwartz, the global forwarding freight CEO of logistics giant DHL, said while port congestion will start to ease in 2023, there won't be return to pre-corona levels. Probably not, because everyone will be bankrupted from fucking hyperinflation and won't have a job if interest rates keep going up that high. Anyway, it is going to ease in 2023 because no one's going to be able to afford to pay the prices for anything. It's not going to go back to 2019, Mr. Schwartz told the publication. I don't think we're going back to this overcapacity situation where rates were very low. Infrastructure, especially in the US, isn't going to get better overnight because infrastructure developments take a long time. The good news is that pressure will start to ease next year after a few container vessels are finally delivered and a post-corona demand starts to cool. But other issues such as China's ongoing corona lockdowns, including in Shanghai, which is home to the world's biggest port, are expected to throw a spanner in the works. Mr. Schwartz, reality, right? I got the sickness, right? And it was nothing. It was just like a flu, like, you get a flu. Some people get it tough. Some people get sick. Some people die, right? But the same thing applies when you get the flu, you get whatever. If your time is up, right, it's going to attack you. It's going to attack you. But forcing everybody to go and get enorm and seeing the amount of footy stars and celebrities and movie people and people in my Facebook feed continuously because of things going wrong, that would be a bigger concern, right? We're not going too far off topic from our economy chat today. We're not going down that road. But you think that they would close the whole world's economy, crash vital infrastructure, crash every government, get everyone laced in debt because of that, right? It's a bit odd. Equally as odd as why the largest port in the world is closed down. We've got to look at that. When we think about it, right, China can't produce their cheap stuff anymore because they still have to buy coal and they have to put that in the power plant to get the power, and then they can make all the stuff. So if you think you're going to get your cheap cars back, you think you can get cheap anything, it's not going to happen, right? Inflation is here to stay. You can add in, extra interest rates and all these different things. Like we learned with Turkey last week, interest rates have come down by 5%, I think it was, because it wasn't working. And talking about crashes, this one here is a big doozy of a one, right? This one of my clients sent this to me last night. Another Zero Hedge article. It's a lovely one. Japan is on the verge of a systematic collapse with dramatic, unpredictable, non-linearities, whatever word it is, in financial markets. Deutsche Bank warns. Less than a week ago, we wrote, as the yen crash accelerates, it puts a catastrophe at the end of modern monetary theory experiment in the spotlight. A less than cheerful assessment echoed this morning by Bloomberg, which writes that Japan starting to crack it as the yen tumbles with stocks and bonds, noting that despite the yen crashing to a 24-year low, the same reasons we have repeated again and again, namely, you can't keep your 10-year yield at 0.25 and avoid a currency collapse in a scorching inflationary environment. Tokyo stocks were down the most since March, right? So let's just go and look at that, right? We've got Japan, which everyone knows that they've been on flatline interest rate forever, right? We've now got them rising from 20 basis points, which is 0.2%, to 25 basis points. I can't even read this shit right. It went down, it had been straight line at 23 basis points forever, right? And then it went down to 20 basis points, so 3 basis points down, and now it's up to 25 basis points, right? I made a video on this about a year ago, and I said house prices could end up in Mount Druitt at $10 million, and it's very easy. I think it was $6 million, right? From 600 grand to $6 million, I could see a house in Mount Druitt 10x, right? Some people thought it was stupid. Some people thought, wow, that has some theory behind it. I did a whiteboard session. I shared with everyone. So go and check it out about how prices can go up, crazy still. But when we look at that, well, look at this, right? That's the bond chart. That's the 10-year Japan bond yield. It was pretty much straight here. That's 23 basis points. This line up the top's now 25 basis points. The system's fucking dying because they moved 2 basis points. Two. We've seen 75. We're seeing in America 75 next week. We're seeing another 75 next month. 150 basis. 2. They died because they had 2 basis points go up. Deutsche Bank, George Sarah Velos, shockingly calculates in a post this morning titled "The Printer is on Overdrive" and available to professional Zero Hedge subscribers. If the current pace of buying persists, the bank will have bought approximately 10 trillion yen in June. 10 trillion yen in 1 month, right? Is what they're buying. To put that number in context, it's roughly equivalent to the Fed doing more than 300 billion of QE per month when adjusting for GDP. The Bank of Japan is printing the Fed equivalent. Here we are. So if we look at this here, right, up until the year 2013, it was flat, right? And then up, then down, then up, and then slowly down, and then up. So we'll look at that. You see, it's just not normal. It's been there before. This is a truly extreme level of money printing, given that every other central banker in the world is tightening policy. It is one of the reasons we have been bearish on the yen, and so many have been argued currency intervention is in this environment is simply not credible, given that the Bank of Japan itself that is the cause of the yen's weakness. So let's just look at currency crisis here. Let's just assume that we've got a currency crisis, right? Let's say, okay, if Australia doesn't increase its interest rates and the US is trying to increase the interest rates and every other country is trying to increase their interest rates, if the US increases its interest rates and Australia doesn't, it means that the US dollar is becoming stronger against the Aussie dollar, right? That means that if the US dollar went up, Aussie dollar stayed low, people coming here would be cheap. It'd be good if we were sort of exporting goods. However, if we were to buy goods, which we're buying most of our stuff because we're consumers and not producers here in this country, it would mean that everything would rise in value, right? So there's many other pressures that are surrounding our interest rates. It's not just two-dimensional, right? Everyone here's thinking, oh, property this, property that, property the next thing. Reality is that property is just a part of the chessboard, and it's much, much bigger than that. I've got a couple of other things I wanted to chat about, but before that I'm going to get to your questions and comments, and I'll read through a few of these and get onto a couple of other things about what I'm seeing in the property markets out there at the moment. Too many things popping up on my screen here at the moment. Don't they offer 30-year fixed loans in the US so the impact is only felt by a part of the population? Correct, they do offer that. Um, but when interest rates go down to nothing, then your property is locked. Also in the US, the loan is attached to the property, not to you as a person, so they're non-recourse loans. Clinton, love your talk. Thank you. Money printing. Daniel said here, looks like a hockey stick. Yes, that is what it is. Patrick said M2 money supply, money print. Danielle got it right. Coal. Adam got it right. Coal. Patrick M2. Ramon said the amount of money that has been printed. What have we got here? Will we see a world war that will reset everything? Anthony, I think that we are in a war at the moment, a war on our consciousness, a war on our minds, a war on misinformation, right, that comes out every day trying to get us to clickbait just as much as Kim Kardashian with the new arson plan or whatever she's doing this week. We're in a war as it is. Having critical thinking, having calculated decisions, being educated with the moves that you are making are very, very important. So if we had a war, it would be interesting, but I believe that we are in a war. Instead of using guns and all that, they're using our intellect and our brainwashing capacity to keep us suppressed. Giuseppe, do you see monetary system collapse to lead us into a digital currency and a social credit system? 100%. We're seeing the whole financial market burn up right now. We have one more cycle left of our currency as it is. We are right on track to where I would have predicted things to be. I always said that I think that the system could only support a 25 basis point increase times 2, so 0.5% basically. Anything beyond 0.5%, we'll see the whole system blow up. They will have to come back with more stimulus packages, lower interest rates, easier money policies, all different things to help combat a massive depression. I'm not negative. I'm not scared. I'm the most excited guy, most positive and optimistic bloke that you'll come across. With it, we will end up in a social credit system that will be based on a thing called an ESG, which is environmental social governance, meaning that if if a business changes their logo to the rainbow flag like every other big company has done, you'll get special bonus points, you get extra money, cheaper interest rate, cheaper bills, whatever. It'll be a programmable social credit system based on the types of practice that you put in your businesses, the ways that you conduct your life, etc., etc. We will have a social credit system. That is the bad thing that's coming. Be prepared for it. Take steed at sort of making moves to be able to work outside of that system that we're currently in, because our system we have, the days are limited. I love talking about property. Property's one of my favorite things. I called my business B.Invested 14 years ago when I first started the business, because I'm an investor. Property is my favorite go-to, but I do invest in all different things. And I think more than ever now, having access to many different sort of survival mechanisms that you're not tied to the system, because in the new world, when we reach that point, they're going to have us and have our asses served to us on a plate. So that is the war that we're in. Clinton, what about the NWO and the transfer to the digital world and the currency with one world government? 100%, that's where we are heading. That's what this whole war is about that we're in at the moment. It's the NWO digital world currency and control mechanism that's being controlled via, if you know about these sort of things, you know who's controlling it and the layers that are there. So printers go brrr, they do. After a while, that printer that's going 24 hours is either going to run out of paper, it's going to run out of coal to run the power to run it, or it's going to blow the fuck up. And that's where we're at in the next decade. Daniel said I've got about 850 equity in investment right now. What should be my next move? Lots of variables there, Daniel. I can't answer that because everybody's position is different. If you would like, inside the description of tonight's video, there's a link there. You can click on the link, reach out to my team. I've got like 100 staff in my office. They've all gone home now. I've got a couple here, I think. But I've got like 100 staff in my office that are here to help people, work out where they are, what they're trying to do, and get to where they want to be. So all it starts with a conversation. It's a free conversation with my team. If you want to use any of my services, I have a law firm, an accountancy practice, financial planning, a finance company, real estate offices nationally. If you're homeless and need somewhere to stay, I've got lots of rental properties. If you need a holiday, I own lots of motels and food shops and all different stuff. So inside my office here, this is where we help our investors reach financial freedom from, putting the right strategies in place. As I said, when I first started this video today, I'm not a financial planner or advisor. I think I do a better job than them. But there's no disrespect to any of the ones that I know and trust and like. There's very few and far in between that I do, but there's some really good ones out there. But yeah, with it, reach out to my team and let's have a chat. Peter said, what would you do with 200K? There's lots of things that I would do with 200K. Most importantly, there's a lot more things I could have done with 200K than what I could today, because inflation has destroyed the purchasing power of that money. But if I had 200K and I was starting out today, and I think that might be the question that you're asking, that's why detail is very important in the comments of asking me what to do. But if I was starting out again with 200K and I had an income or an ability to earn an income, I would take that 200K, use it as 4 deposits, go buy 4 properties and start collecting as many assets. Because once this system blows up, just remember, guys, debt becomes irrelevant with inflation, right? Inflation makes the currency worthless. It also makes the debt worthless. So those that control the currency understand that this is the game, right? So at the fall of any currency, the debt always becomes worthless. The one that walks out holding all the jewels is the one that's the king. So make sure that you set yourself up, make sure that you have the right strategy to be able to go through this this next cycle. Peter said, where is this negative interest rate you were on about a couple of years ago that would happen after the corona in Australia? Look, it's still, a lot of people are scared about interest rates going up. I'd be more scared about interest rates going down. I'm excited by them going down. I'm the first one out there telling you that interest rates are going to come down. When I said that interest rates were going to go negative, I was laughed at. I was told that interest rates are already low at 5%, 4%. They can't go any lower. They've never been 1.5%, whatever. Interest rates got to 10 basis points. It's below inflation, below everything, right? Interest rates will go negative. The systems have not been built for negative interest rates here in this country. They have gone negative many other countries, and I believe that this is stress testing for negative interest rates, and I believe that they're here within the next 12 to 24 months. I put my reputation on the line, I throw it out there, so hold me accountable to it, and I appreciate the accountability. Anthony said, I want to see a debt jubilee. I don't think we're going to get a debt jubilee in the fact that all our debts become worthless, because our debts are owed to all different individuals. I believe where the debt jubilee will come from is hyperinflation, and our debt becomes worthless and you're paying off loans with really devalued currency. I only invest in real estate, gold and whiskey. At least if it all goes to shit, I can have a drink. That's a good outlook, Anthony, and it's I think that you're onto the right sort of the right path there. Be open to investing in the food, energy, and resources that you need on a daily basis to keep yourself and your family, fed and nourished and all that sort of stuff as well. But you're on the right track there. Robbie, what do you think about the 4 banks in Australia? When will they go broke? I actually think, I said this many years ago, I actually think a bailout in 2008, 2009, the GFC, we saw companies and banks and institutions go broke. In this cycle, we're going to see countries go broke, and then we're going to see our currencies go broke. I don't think they're going to go broke right now, but I think that as our currency loses all of its value, if they cannot have the ability to print money, so imagine, let's just assume a bank has $1 billion in its books, right? The bank doesn't have money. That's not what the bank's business is. The bank's business is to lend out money and create money. So it makes money from giving out $1 billion of loans and collecting 0.5% or 1%, 2%, whatever they're making. Let's say they're making 1% of $1 billion. That's their profit. So that's how they make their money. Now let's assume that that no one's taken out new debt, right? And the debt level stays at $1 billion, or it becomes a little bit less, or it goes backwards, and instead of it being $1 billion, it's only 800 million. What would happen at that point? You've still got all the wages to pay, you've still got all the lights to keep on, you've still got all the electricity. Just think about it this way. The bank needs to pass on the power cost for all their computers, their staff, their servers, all that. All these things, the costs are going up. So if you don't have money creation happening at the bank at a faster rate than all of this, then the banks would go broke. So it isn't impossible, but I think if the banks, what would happen to the banks, because they've literally got the ability to print as much money as they want, is that the banks they could have their books bailed out in a worst case scenario via the RBA, which you'd see a bank in its current state, but it would be a vegetable version of itself. Vic said, I'm planning to move to Melbourne from New Zealand. Any advice? Look, I've seen your Prime Minister in New Zealand, and she's not that attractive. That's my first bit of advice. And just feel evil, right? Just feel evil coming from it. Evil vibes. And, you know, the bloke that runs Melbourne doesn't seem to be too much better. So just make sure you're not jumping out of the boiling pot into the fire. There's other cool places around the country. But, yeah, on that, you know, I'm not hateful of Melbourne. I just know lots of people out there that don't like their environment that they've got and the controlling powers to be. So that's just my 2 cents of an opinion, if that's worth anything. Jack Birchie, do you follow Phil Anderson's 18.6-year property cycle? I've looked into it briefly. It didn't appeal that much to me. There's many other factors. You can't sit there and go, oh, it's 18.6 years and these sorts of things. You know, when people start talking about these things, they're going back on historical data, but that data is irrelevant, right? Would Phil Anderson's 18.6-year data have this on it? Right, just give me 2 seconds. Would Phil Anderson's data show that the power stations are going to blow up because they can't afford to buy the coal for it? They're things that aren't in it. So when anyone, you know, sort of prophesizes about the future, like, I'd want to see exactly why and the ins and outs of it, and I'd like to challenge it. It's challenging. I love when people challenge what I have to say, but I'm just looking at data and going, well, 1 + 2 = 3, and you know, it doesn't equal 20, doesn't equal 80. You can manufacture it, manipulate it, turn it all around as much as you want, but it's yeah. So that's just my thoughts on that. Matt, Nathan, what should we be watching for a trigger of a collapse? The bond market. Keep watching Tuesday Night Lives. I'm going to keep doing these chats, and I'll keep sharing with you my thoughts as they arise and they come through. But there's lots of moving parts out there at the moment. There's not one thing that would trigger, because they're just literally strapping Ponzi schemes on top of Ponzi schemes. So yeah. Frank just said to stay in New Zealand. Look, Australia's a cool place. Lots of cool things here. Yeah. Real estate, Australia, what have we got here? Hey Nathan, the Gold Coast experienced unprecedented growth since 2020, more than Sydney and Melbourne. Do you see the wheels falling off the Gold Coast market, the Melbourne and Sydney? It's a good, wow, there's so many questions, wow, so many comments down here. Where we go. So Gold Coast, I was buying the Gold Coast, and I said to everyone, I actually was on the Sunday night program. I did a 40-minute documentary they did on me, and I was talking about the Gold Coast. I did the helicopter ride over the Gold Coast, and they were looking at the properties and stuff like that. And I said that if Sydney's the New York of Australia, you know, the Gold Coast is the Miami of Australia, right? It's where everybody wants to go for lifestyle. And I said that when the property market booms next time, that the Gold Coast would be the first market to take off, and it has done. I was buying 50 properties a month in the Gold Coast for myself and for my clients for many, many years. I stopped buying there about 2 years ago. I buy there maybe 3 or 4 a month instead of 50 like I was. And that's just due to the fact that the value isn't there. Everything's overinflated and too high. Why would you want to be paying at the top? Is it going to crash? It still has upside for growth. It still has more scope and more room. In my personal opinion, I think it's got a lot of value there and a lot of opportunity. But why would you want to buy something like properties I was buying for 150, 200 grand in the Gold Coast and now selling for 500, 600 grand? Properties I was buying for 500 and now selling for $2 million. I'm in other sort of markets. I buy everywhere. I buy all across the country. I was going to talk to some of you guys about some deals that I'm working on and stuff like that. I'll get onto that shortly, and I'm not going to tell you exactly where or anything like that, but I'll talk about the numbers of what I'm looking at and why I'm buying certain properties that I'm buying. So I will share that with you in the next, say, 5 minutes or so. Peter said, where would you buy 4 properties with 200 grand? You'd want to buy properties at an average price of about 200 grand a piece. If you can buy a property for 200,000, it rents for 300 to 350 a week. It's going to give you positive cash flow. You don't have to worry about interest rates. It's going to have the ability to go up, and 200 grand's below rebuild cost, and it's in that safe line where a lot of people can still afford to pay the mortgage. So the upside from that is not like buying a $2 million mortgage sort of area. But if you buy a property for 200k, put down 40 grand deposit, 10 grand for closing costs. You got 160k loan, 160k loan. Let's even call it 5%. That's still 8 grand a year, $160 a week. So, yeah. Johnny said they're everywhere. You might be looking for the wrong places. Correct. Hey mate, do you think property prices may fall in capital cities due to fear of increasing rates before the next hyperinflation melt up? They may do, but I doubt it. Just depending on how far they try and squeeze this market out. Yeah. What have we got here? Who's going to reinsure Australia? Don't know what you mean by that, but if it's about the banks, it's all a Ponzi scheme anyway. What else we got here? Robbie, thanks Nathan. Thank you very much for doing these open chats. They really do help the community. Appreciate it. Luke, hey Birch, which companies in Australia would you consider too big to fail? Would such bailouts rampantly escalate? QE, PS, shout out to the fish. Thanks, mate. Nothing's safe. Nothing's safe. Not even our government safe. Not even our government. Tommy said, all my neighbours come to my place every Tuesday to watch you. They thank you and grateful. Thanks, Tommy. Appreciate that. Yeah, thanks for everyone for checking in as well this week. I've got a bit of a... sorry, just got heaps of text messages coming through while I'm chatting. I'm trying to look up something on my phone here. So, opportunities to buy below market, right? A lot of people sort of fear and they're like, in this current market, what's happening, etc., etc. Just some deals that I did this week. I bought a property in Sydney for 307,500. It sold last 7 years ago. So before this boom in Sydney for $346,900, right? So 7 years ago, the property sold for 40k more than what we're paying for it today. The owner would have been in negative cash flow. The rents have gone up. Interest rates are down. They would have had to pay stamp duty, holding costs, sales fees, all that sort of stuff. 40k cheaper than what it was 7 years ago. That, for me, is 300 grand in Sydney. Goodbye. 275,000 in Sydney. Previous sales at 350 in the same complex. That's in Sydney, and that's cheaper than what it was 7 years ago. So most people are looking at properties and going, wow, they're too expensive, because they're looking at areas that have all gone up, but there's lots of markets that you can still buy today for cheaper than what they were previously. Queensland, one that I did, 170k, sold previously in 2009 for 225 grand, so 55 grand cheaper today than what it was 13 years ago. So 55k cheaper than 13 years ago. Rent on it for 280 a week. The property's double brick, modern. It's probably only about 25 years old. Depreciation, all that sort of stuff. Houses, I've got 3 houses in an area, 120 to 125 grand each. Sold previously for 400 grand and rent for about 270 to 300 a week. Yeah, you can't build a house for that price. Brisbane CBD area, just bought one for 378 for a 3-bedroom modern townhouse. Previously it was sold 8 years ago, brand new, for 375. So all these booms that are happening, you can still find deals out there. So on that note, I've been told from my team, keep it not to a 2-hour Facebook Live. So I'm going to sort of wrap it out now. But what have we got here? Just no. Thanks, mate. Appreciate it. All these power blackouts. How will we get those robots with all these recharged? Exactly. They have to put a solar panel on them, and get someone with dyed hair to go and rub it the right way or something. I don't know. Johnny, settling on a very nicely renovated 3-bedroom home, 650, 300. Congratulations. If you need help managing that property, reach out to my team. We manage lots and lots of properties, thousands of properties. Vic, what's a good website to buy property in Australia, Sydney or Melbourne? There's website realestate.com.au, which is sort of just a website here in Australia. Check that out. If you need help as a buyer's agent, I purchase all the properties for my clients, personally myself, for my investors. See if you need help on buying a property that's below market value with good upside for growth, good investment, reach out to my team. The description is in the box with the link there, so you can see it somewhere around here. And also, if you do like the weird stuff that I talk about, all this data and whatnot, I do try and share this as much as I can, even about weather control and all other weird and wacky things at birchfeed.com. There's a link in the description as well that you can chat to. So with it, thanks a lot for joining in tonight, guys. Keep being awesome. Keep being diligent. Keep your brain. It's the big thing out there. It's a commodity that not many people have today. They obey without questioning, and I think it's important to question, have a clear understanding of everything that you're doing, and make moves accordingly. If you need help, reach out to us, 1300 367 925, or click on the link on the side wherever it is on your device. Booking a free 15-minute discovery session with my team. Catch up soon. See you next Tuesday. Bye for now.